More than $6 trillion vanished in 60 minutes if you bought the top thoughts and prayers. Silver just crashed from $121 to $108. Gold dumped from $5,600 to $5,100. And most people have no idea why. Right now, somewhere in the world, someone is staring at their screen watching their portfolio bleed. Liquidations triggering liquidations. A cascade of red. Stop losses getting hunted, leveraged positions getting wiped, and the mainstream financial media, they'll tell you it's just volatility, normal market behavior, nothing to worry about. They're lying. What happened today isn't random. It isn't unexplainable. And if you don't understand why this crash happened, you'll get destroyed by the next one. But here's the thing. I've seen this exact pattern before. Not months ago, not years ago, weeks ago, December 2025. The last 2 days of the year, same crash, same panic, same liquidations. And you know what happened next? January exploded. Gold up 30%, silver up 65%, the biggest monthly rally in decades. So is today's crash the end or the beginning of something much bigger? By the end of this video, you'll know exactly what caused this crash. You'll understand the hidden force that moves gold and silver that most investors completely ignore. And I'll show you the historical pattern that could tell us exactly what happens next. But here's what most people will miss. I'm going to reveal something that could change how you trade these markets forever. A specific prediction with a specific date on the record. If you click away before that, you'll miss the one thing that could turn this crash into your biggest opportunity. Stay with me, this is important. Welcome back to Chill Guy, where we cut through the noise and break down what's actually happening in the markets while everyone else gets distracted. If you're new here, hit subscribe and turn on notifications, because what you're about to see could save your portfolio. And as we go, drop a comment with what you think caused this move, because I read them all. Now let me break down exactly what happened. Today is January 29th, 2026. At approximately 10:30 a.m. Eastern, gold was trading at $5,600 per ounce. Silver was at $121. 60 minutes later, gold had crashed to $5,100. Silver collapsed to $108. That's $500 wiped off gold. $13 wiped off silver in 1 hour. Let me put that in perspective. If you had $100,000 in silver at the top, you now have $89,000, $11,000 gone in the time it takes to watch a Netflix episode. And if you were leveraged, if you were using margin, if you bought call options expiring this week, liquidations triggering liquidations. That's not just a phrase. That's exactly what happened. When price drops fast, leveraged traders get margin calls. They have to sell. Their selling pushes price lower. That triggers more margin calls, more forced selling, more liquidations. It becomes a cascade, a waterfall of red. And the people who bought at the top, the ones who saw gold at $5,600 and silver at $120 and thought, it's going higher? Thoughts and prayers. Now here's what nobody is telling you. This crash didn't come out of nowhere. There were warning signs. Clear signals that something was about to break. And let me be real with you about something. This crash was not an accident. Crashes like this never are. Somewhere, someone knew this was coming. The big players, the institutions, the ones with access to information you and I will never see. They saw the Fed signals before you did. They saw the China data before it was public. They positioned themselves before the crash happened. And when it hit, they were ready. They were on the right side. They were the ones buying your panic sells. This is how the game works. It has always worked this way. The question is whether you want to keep being the victim or start understanding how the game is played. But before I show you what caused this, you need to understand something critical. Gold and silver did not crash because something is wrong with gold and silver. They crashed because of something else entirely, and that something has a name, the DXY. If you don't know what the DXY is, pay attention, because this might be the most important thing you learn today. And I guarantee you 90% of retail investors have never even heard of it. DXY stands for the US dollar index. It measures the strength of the US dollar against a basket of other major currencies: euro, yen, pound, Swiss franc, Canadian dollar, Swedish krona. When the DXY goes up, the dollar is getting stronger versus those currencies. When the DXY goes down, the dollar is getting weaker. Now here's the critical part that will change how you see gold and silver forever. Gold and silver move opposite to the dollar. They're inversely correlated. Not sometimes, not occasionally, almost always. Let me explain this simply because it matters. Gold and silver are priced in dollars. When the dollar gets stronger, it takes fewer dollars to buy the same amount of gold, so the dollar price goes down. When the dollar gets weaker, it takes more dollars to buy the same amount of gold, so the dollar price goes up. Think of it like a seesaw. Dollar on one side, gold and silver on the other. Dollar goes up, gold and silver go down. Dollar goes down, gold and silver go up. They can't both be up at the same time. They can't both be down at the same time. That's not how the seesaw works. This is why professional traders don't only watch gold and silver charts. They watch the dollar. They watch the DXY, because the DXY often tells you what gold and silver are about to do before they do it. Today, the DXY pumped hard. The dollar surged against other currencies. The dollar side of the seesaw went up, and gold and silver got crushed. This isn't complicated. This isn't a conspiracy. This isn't manipulation. This is basic market mechanics that most retail investors ignore. They watch gold, they watch silver, they stare at charts all day, but they never watch the dollar. And then they're shocked when this happens. They call it manipulation. They call it unfair. They don't realize they were watching the wrong thing. And if you learn nothing else from this video, learn this. Watch the DXY. When the dollar spikes, prepare for pain in metals. When the dollar drops, prepare for gains. And here's the scary part. Most retail investors don't even know this relationship exists. They buy gold and silver without ever looking at the dollar. Then they wonder why they keep getting stopped out, why they keep buying at the wrong time, why the market feels rigged against them. It's not rigged. They're watching the wrong thing. The professionals, the institutions, the hedge funds, they watch the DXY like hawks. They see the dollar spiking and they dump metals before retail even knows what hit them. By the time you see the red candle on your gold chart, they've already sold. You are the exit liquidity. Today, you became exit liquidity for someone else, unless you understand this. Now let me tell you why the dollar pumped today, because understanding the why helps you predict the next move. There are 3 reasons, and each one matters. Miss any of them, and you won't understand the full picture. Reason number 1, the Federal Reserve. The Fed has been sending hawkish signals. For those who don't know, hawkish means leaning toward keeping rates high or even raising them. Dovish means they want to cut rates. Right now, the Fed is hawkish, very hawkish. Higher rates make the dollar more attractive to foreign investors. Why? Because when rates are high, you earn more by holding dollars. You get better yields on treasury bonds. You get better returns on dollar-denominated assets. So what do foreign investors do? They buy dollars. They convert euros, yen, pounds into dollars to get those higher yields. More demand for dollars means the dollar strengthens, DXY rises. And when DXY rises, you already know gold and silver fall. The Fed hasn't cut as much as people expected this year. Everyone thought they'd cut aggressively. They didn't. They're worried inflation comes back. They're talking tough. They're saying rates may stay higher for longer. And the market is listening. The market always listens to the Fed. That's reason number 1. Fed hawkish, dollar strong, metals weak. Reason number 2, China. This one is specifically bad for silver. If you hold silver, pay attention. China's industrial activity is slowing. The latest data shows manufacturing contracting, factory output declining, momentum fading. Why does that matter for silver? Because silver isn't just a precious metal. It's an industrial metal. More than 50% of silver demand comes from industrial uses. Solar panels. Every single one needs silver. Electronics. Your phone has silver in it. Your laptop has silver in it. Electric vehicles. EVs use more silver than regular cars. Semiconductors. AI chips. Data centers. All need silver. And where is a massive chunk of that manufacturing happening? China. When China slows down, industrial demand fears spike. Traders start thinking maybe demand drops, maybe fewer panels, fewer electronics, less silver needed. Fear hits, selling starts. And silver, being more volatile than gold, crashes harder. That's why silver dropped around 11%, while gold dropped around 9%. China hit silver harder because silver is tied to industrial demand. That's reason number 2. China slowing, industrial demand fear, silver gets hit. And I wish I could tell you that's the worst of it, but it gets worse. Reason number 3, the U.S. government shutdown, January 31st. 2 days from now, if Congress doesn't pass a funding bill, shutdown risk rises. Shutdowns have happened before. They're usually temporary. They usually get resolved, but markets hate uncertainty. Markets hate political chaos. When there's uncertainty, traders reduce risk. They take profits. They move to the sidelines. They sell first and ask questions later. After the massive rally this month, gold up 30%, silver up 65%, there was a lot of profit sitting on the table. People were looking for an excuse to lock gains. Shutdown fears gave them that excuse. Not the only reason, but the trigger, the justification. That's reason number 3. Political uncertainty, profit taking, risk reduction. 3 forces hitting at the same time. Fed hawkish, China slowing, shutdown looming. Each one alone could have caused a dip. All 3 together, same moment, same market, boom. Over $6 trillion evaporated in 60 minutes. Now let me show you something most people don't understand, the relationship between gold and silver. A lot of people think gold and silver move together, same direction, same intensity. That's dangerously wrong. Yes, they often move in the same direction, but not with the same intensity. Silver is gold on steroids. When gold moves 5%, silver can move 10 to 12%. Gold up 10%, silver up 20. Gold down 8%, silver down 15 to 20. Look at today. Gold dropped about 9% from 5,600 to 5,100. Silver dropped about 11% from 121 to 108. That's not coincidence. That's the silver multiplier. Gold leads, silver follows, amplified. That's why silver gained 65% this month while gold gained 30%. And that's why silver crashed harder today. If you trade silver, you need to understand this. Silver can make you rich faster, but it can also destroy you faster. The leverage cuts both ways. Now here's something fascinating. Look at Monday, just days ago. We had another crash. But that one was different. On Monday, silver crashed 14%. Gold only dropped 2%. Why? Because Monday's crash was silver-specific, industrial demand fears, China-driven, silver-only selling. Today's crash is different. Today, both gold and silver crashed together. Gold down 9%, silver down 11%. When both crash together like this, it's not a silver-specific cause. It's macro. And today's macro cause was the dollar. DXY pumped. Both metals dumped. That matters because it tells you what to watch. If you want to predict the next crash, watch the dollar. Not just gold, not just silver, the dollar. When DXY spikes, prepare for pain. Now here's where it gets interesting, and this is the part you really need to focus on. I've seen this exact pattern before. Not years ago, not months ago, weeks ago. December 2025, the last 2 days of the year. December 30th and 31st, almost identical setup. A sharp crash out of nowhere. Panic selling everywhere. Liquidations cascading. Red candles stacking. Weak hands getting destroyed. Sentiment was horrible. Social media was full of doom. People called for the end of the bull market. They said the rally was over. They said gold and silver were finished. They said the top was in. Fear was maxed out. Despair everywhere. And then January happened. January 2026, the month we're still in. Gold up 30% in a single month. Silver up 65% in a single month. Record highs broken, shattered. The biggest monthly rally in over 40 years. All those people who panicked in December, who sold at the bottom because they were scared, who listened to doom and gloom. They watched the rocket launch without them. They sold low. They missed everything. Now look at today, January 29th, 2 days before the end of the month. Sharp crash, panic selling, liquidations cascading, same pattern, same timing, same fear. So the question is, will February repeat January? Will we see another mega pump? Let me show you why I think we might. First, understand what has not changed, because this is critical. Today's crash was about the dollar, about the Fed, about short-term fear, about paper hands getting shaken out. But the fundamentals, the big picture, the stuff that actually matters, none of that changed, not one bit. While you were panicking, Tether was still buying 1 to 2 tons of gold every week. They didn't stop because of a 60-minute crash. They don't care about your fear. They are accumulating. While you were watching red candles, BRICS nations were still stacking. China, Russia, India. They didn't sell today. They bought. They buy dips. They've done it for years. While you were refreshing your portfolio, the de-dollarization trend was still accelerating. Countries are still moving away from the dollar. That doesn't reverse in 60 minutes. While you were questioning everything, the silver supply deficit was still real. 5 consecutive years of deficit. Mines are still depleting. That didn't change today. You know what changed today? Sentiment. That's it. Just sentiment. Weak hands panicked. Strong hands accumulated. And sentiment can flip on a dime. It flipped negative today. It can flip positive tomorrow. Second, look at what happens after sharp crashes. In a bull market, crashes are buying opportunities. They shake out weak hands. They reset overbought conditions. They create fear. And then big players step in. They buy the fear. They accumulate lower. They load up while retail panics. Then the rally resumes stronger than before. This has happened again and again in this bull market. So are we still in a bull market? Look at the evidence. Gold is still up huge on the year, even after today's crash. Silver is still up massive, even after today's dump. Central banks are still buying at record levels. The dollar's long-term trend is still down. Today was a spike, not a reversal. Nothing suggests the bull market is over. Everything suggests this is a correction inside a larger uptrend. But I could be wrong. And I know what some of you are thinking right now. Here we go again. Another YouTube guy telling me to hold through the pain. Another guy telling me to buy the dip. I've heard this before. Look, I get it. You're tired. You're scared. You just watched your portfolio drop double digits in an hour. The last thing you want is someone telling you to stay calm, but I'm not telling you what to do. I'm showing you the data. I'm showing you the patterns. I'm showing you what's happened before in identical situations. What you do with this is your choice. I just want you to have the facts before you choose. That's why I'm going to give you 3 scenarios. Then I'm giving you a specific prediction on the record. Scenario 1, the bull continues. This crash is like December, a shakeout before the next leg up. February starts strong, new highs by March. Silver breaks 150, Gold breaks 6,000. Probability? I'd say 60%. Scenario 2. More pain is coming. The Fed gets more hawkish, dollar keeps rising, China data gets worse, another crash. Gold tests 4,800, silver tests 90. Probability? I'd say 30%. Scenario 3. The chop zone. We go sideways, no new highs, no major crash, just choppy, frustrating price action for weeks. Traders get bored. Retail gives up. Then the move comes when nobody expects it. Probability? 10%. Now here's my specific prediction, the one I promised at the beginning. Silver will be back above $120 by February 15th. Not by March, not by summer, by February 15th, 17 days from now. Here's why. This crash took silver from 121 to 108, 13 are down. That's huge in 60 minutes. But it's nothing compared to the rally we just had. The December pattern says we bounce. The fundamentals say we bounce. Oversold conditions say we bounce. And February 15th is when the shutdown drama gets resolved one way or another, when fear fades and buyers come back. $120. February 15th. On the record. Screenshot this. Hold me accountable. Which scenario do you think plays out? Drop your answer in the comments. I read every single one. Now let me give you practical takeaways, because understanding what happened is useless if you don't know what to do about it. If you're holding physical gold and silver, my advice is simple. Do nothing. Physical metal isn't a trade. It isn't something you flip based on daily price movement. Physical metal is insurance, long-term savings, wealth preservation. You don't sell your insurance policy because the stock market had a bad day. You don't cash out your savings account because there was a market crash. Physical metal is the same. You don't have a loss until you sell. Until you sell, it's just a number on a screen. It doesn't change how many ounces you own. If you bought physical silver at $100, you still own that silver. It's still in your possession. The crash didn't take it from you. Ignore the daily noise. Come back in 6 months. Come back in a year. Fundamentals haven't changed. The long-term thesis hasn't changed. Only the short-term price changed. If you're trading with leverage, today was your wake-up call. Leverage in volatile markets is a death sentence. Not maybe. Liquidations triggering liquidations should haunt you, because that's exactly what happens when leverage traders get caught wrong. You think you're smart. You think you can handle volatility. You think your stop loss will protect you. Then price gaps down. Your stop loss gets skipped. You get liquidated worse than you expected. Your account is gone. This happens every time there's a sharp crash. Leverage traders get wiped out. Every single time. If you're using leverage on gold or silver, reduce it dramatically or eliminate it entirely. The gains aren't worth the risk of total wipeout. If you're on the sidelines with cash, this might be your moment. The best time to buy is when there's blood in the streets, when fear is everywhere, when red candles stack. That's when smart money accumulates. That's when the wealth transfer happens, from panicked to patient, fearful to prepared. But only buy what you can afford to hold through more volatility. Because I can't promise this is the bottom. There might be another leg down. Buy in trenches. Don't go all in at once. Buy some now. If it drops more, buy more. Average in. And only use money you can lock up for months or years, not money you need next week. If you bought the very top, silver at 121 or gold at 5,600, I'm not going to lie, it hurts. Watching your portfolio drop 11% in an hour hurts, I understand. But you have two choices. Choice 1, panic sell at the bottom and make the loss permanent. Transfer your wealth to whoever is buying from you right now. Choice 2, hold through volatility and wait for recovery. You bought at a bad time, but bad timing isn't the same as a bad investment. If fundamentals are still good and the long-term thesis is intact, then your mistake was timing. And timing mistakes get corrected over time. History favors the patient, but you have to survive the drawdown emotionally. You have to watch red without panicking. You have to hold when everyone else is selling. Can you do that? Only you know. Now let me address something important. Some of you feel sick right now. You're watching your portfolio wondering if you made a mistake. Let me give you perspective. In 2020, gold crashed 30% in March. People panicked, sold, said gold was dead. By August, gold hit all-time highs. In 2008, silver crashed 50%. People said it would never recover. 3 years later, silver hit $50. Every bull market has corrections, every single one. The question isn't whether corrections happen, they always do. The question is whether you have the conviction to hold through them. Conviction comes from understanding. If you understand why gold and silver rise long-term, you can stomach short-term pain. If you don't understand, every crash will shake you out. You'll buy high, sell low, over and over. That's why I make these videos, not to tell you what to buy, but to help you understand what's happening so you can make your own informed decisions. Now here's what I'm watching. Number 1, DXY. If the dollar keeps pumping, more pain. If it rolls over, metals bounce hard. Number 2, February 1st, the day after the shutdown deadline. The first few days of February will tell us a lot. Number 3, China data. Any sign of stimulus or recovery is bullish for silver. More bad data is bearish. Number 4, Fed speakers. What they say this week matters. Hawkish talk means dollar strength. Dovish talk means metals rally. Watch these 4 things. They'll tell you what comes next. Now, there are 3 types of people watching this video. The first is panicking, refreshing their portfolio every 5 minutes, thinking about selling everything, letting fear drive decisions. The second is frozen, doesn't know what to do, so they do nothing, just watch and hope. The third is learning, taking notes, understanding why this happened, preparing for what comes next, because they know crashes create opportunities for those who are ready. Which one are you? Let me leave you with this. Markets are designed to transfer wealth from impatient to patient, emotional to rational, reactors to preparers. Today, $6 trillion changed hands in 60 minutes. Some people lost it, other people gained it. The question is, which side of that transfer are you on? If you panic sold today, you transferred your wealth to someone who was waiting for this, someone who understood the game. If you're still holding, you still have a chance. The game isn't over, and if you're sitting in cash, watching from the sidelines, pay attention. Moments like this don't come often. December crashed. January pumped. January is crashing. February is coming. The pattern is right there. Will it repeat? Drop your thoughts about this crash in the comments. I'll do a follow-up update on February 1st, and we'll see who was right. Now do me a favor. If this video helped you understand what happened today, hit the like button. It helps more people see it. And if you're not subscribed yet, fix that right now. On Chill Guy, we don't do hype. We don't do hopium. We break down what's really happening so you can make better decisions. Share this with someone who's panicking right now, someone who bought at the top and doesn't understand what just happened. Send them this video. It might save them from making a huge mistake. Remember what I said at the beginning, $6 trillion gone in 60 minutes. If you bought the top, thoughts and prayers. But thoughts and prayers don't make money back. Understanding does, preparation does, patience does. The crash happened. You can't change that. No amount of wishing brings those prices back. What you can change is what you do next. What you can control is your response. Will you panic and make it worse? Will you freeze and do nothing? Or will you learn and prepare? The market doesn't care about your feelings. It doesn't care that you're scared. It doesn't care that you bought at the top. It only rewards people who understand it, people who prepare for moments like this, people who have a plan before the crash hits. If you didn't have a plan going into today, now is the time to make one. What will you do if we crash another 10%? What will you do if we rally 20%? What's your strategy? Because there will be another crash and another rally set and another crash after that. That's how markets work. That's how they've always worked. That's how they'll always work. The question isn't whether volatility happens. The question is whether you'll be ready. I've been studying these markets for years. I've seen crashes. I've seen rallies. I've seen people make fortunes. And I've seen people lose everything. The difference is never intelligence. Smart people blow up accounts all the time. The difference is preparation, emotional control, having a plan, sticking to it. Today tested everyone. Today separated the prepared from the unprepared. Today showed you who you really are as an investor. So, did you like what you saw? Because the real story is never on the surface. Before you go, subscribe to Chill Guy for daily gold and silver updates and comment which scenario you think plays out next. I'll pin the best answers. I'll see you in the next video. Until then, stay calm, stay prepared, and remember, $6 trillion changed hands today. Make sure next time you're on the right side of that transfer.